That confused a lot of people, but was this part of just a long-run April trend where we've seen bond buying and yields falling?
Well, I think really the price action yesterday, like you mentioned, was just quite puzzling because we did see Treasury yields tumble by the most since late February. And we've had quite a debate this morning on our MLive team about what's behind that move. So it does appear to be the case that it was largely positioning unwinds. It really doesn't change that longer-term trend for yields to kind of climb higher going forward. But it does point to potential risks of this U.S. growth exceptionalism. Perhaps that's already priced in. Perhaps this inflation fears are overdone. We have seen the Fed come out really convincingly with those rate hike bets being pared back. So I think at this point, we're not going to see a near-term direction for yields, but certainly some caution playing out in the market.
And here in Europe, we're going to be looking ahead next week, of course, to the ECB meeting. We've had some guidance around Italian debt and Italian debt levels. Once again, in terms of the percentage of GDP, a bit of an issue. What are we expecting to see there?
Well, certainly what investors are telling us is that debt burdens are clearly on the back burner. So if we look at what's happening in terms of Italian debt yesterday, we did see it rally by the most since mid-March. But I think ultimately that is another blip in that longer-term trend because the ECB is likely to start slowing their bond purchases in July. That's the latest from a consensus survey of Bloomberg forecasters. And that's because the ECB is likely to be hesitant to really step in to curb that reflation trade because we are seeing that growth improvement come across Europe.
Okay, Laura, thank you very much for your time. Good to speak to you. Laura Cooper, Bloomberg's MLive macro strategist. Have a good weekend when we get there. Coming up here on the programme, that is it for the European Market Open, but we will be bringing you plenty more from our conversation with the CEO of the German pharmaceutical company CureVac after the company's vaccine production goals. The goal is to produce 300 million doses in 2021. We already heard a little clip of that. More of that conversation to come in later programming. That is it for, as I say, the European Market Open. Surveillance Early Edition is up next. Blue skies over London this Friday. This is Bloomberg.
The United States is not looking to kick off a cycle of escalation and conflict with Russia. We want a stable, predictable relationship.
The auto industry is a huge network of supply relationships and technology relationships around the world. Our guiding principle is to go for the best.
We have a group of Americans and a group of people around the world who aren't back to work yet, and we need to get that done.
This is Bloomberg Surveillance, Early Edition with Matt Miller.
Good morning. Welcome to Bloomberg Surveillance, the early edition. I'm Matt Miller in Berlin. Here's what's coming up on today's program. Big banks, big bonds. From a record quarter to record debt issuance, JP Morgan sells $13 billion of bonds. Goldman follows suit with a $6 billion sale. Tencent in there as well. We're going to hear from our interview with Bank America CEO Brian Moynihan on the program as well. China's economy soars by 18.3% year over year in the first quarter, but momentum slows from the previous 3 months to just a 0.6% gain. Strong retail sales stand out, but again, it's the base effects from the pandemics that make it look so good. And the $100 million deli, David Einhorn, presents the latest sign of irrational exuberance, a New Jersey delicatessen with a market cap almost 10,000 times higher than its 2020 sales numbers. So first off, the theme of U.S. bank earnings this week is a rebound in profits. We still have more to come. Boosted by a trading bonanza, but tepid loan growth has investors worrying about future earnings. We spoke to Bank America's Brian Moynihan.
Consumers in good shape. There's an unemployment issue. We got to get that the rest of the way down to where it should be. The businesses got to get open that couldn't be. But by and large, a big portion of the economy is up and operating very well. If they're raising because inflation and other things got out of control and wasn't temporary, that's probably not a good thing. So, the question of raising rates is a risk in certain circumstances and an extreme benefit in others, just because it means the economy is normalizing. The number one risk to the world still is getting this healthcare crisis behind us. The best news about the economy, honestly, is the unemployment rate keeps coming down. We're a work-from-office company because of productivity and the culture and the mentoring that can take place is just better. We need to keep critical mass in the places we are and get the people to work.
Let's stick with Bank America, whose shares slid nearly 3% after their result. Danny Berger here with the details. So, Danny, what were the weak spots with B of A's earnings that investors are trading on?
Well, certainly, as you described, that tepid loan growth is part of it. It's something we've seen in all of the banks. Of course, Bank of America, very exposed to the consumer, seeing their net interest income fall about 16%. Still, as I said, we know this would have been a weak spot in their earnings. We know the other banks did this. So that wasn't necessarily the surprise that really took a hit on their share price. Their share price falling nearly 3%, as you said, Matt, and a lot of that had to do with the higher costs that the bank is seeing. Costs rising nearly 16% for the quarter. To this picture, they said that basically the reason that costs were higher is because of COVID, of course, costs associated with that. At the same time, changes in compensation. They're also shrinking their real estate exposure, or their real estate footprint, rather, and that leads to charges as well. The CFO saying that, yeah, some of the COVID costs are stickier than we had hoped for, but this is going to be a one-time thing. They're really sure to flag that this wouldn't continue on.
Just a day after their earnings, JP Morgan took some big action, to say the least. The biggest bond sale on record by a bank, $13 billion of issuance. Why would JPM want to increase its capital so much? Is it just the right time to strike with rates so low?
that definitely is part of it, but rates have been low for a while, Matt. So probably the impetus behind this is a change in regulation. So the banks have this SLR, their supplementary leverage ratio, and it basically says, based on your holdings, this is how much capital you need to have set aside. Now, during the pandemic, when the Treasury market seized up, the Fed said, okay, Treasuries and deposits, that doesn't need to count towards your holdings part of that ratio. Now that relief has gone away, so banks are in a situation where they either need to get more capital or do